So, it's been a while, but let me go directly to the point, okay? So, this video lecture is made to answer the comprehensive problem that I introduced in the past episode. And this is actually the comprehensive problem. So, we have here, Baby G availed a loan from BBM on January 1, 20X1. So, the details of this loan are the following. So, nominal rate is 12%, and the principal amount is 2 million, and the origination cost paid by Baby G is 137,226, and the maturity date is 12/31/20X5 or year 5. So basically, Baby G did not receive the full 2 million. Baby G only received 1,862,774. However, even if this is the case, Baby G is still to pay two types of liabilities. So the principal at the end of the maturity term, which is at the end of year 20X5, so that's the first liability, and the second type of payable pertains to the interest of 12% or 240,000 every year until the end of 20X5. Now, here's the twist. Baby G paid the interest due on December 31, 20X1. However, during 20X2, the borrower began experiencing financial difficulties, requiring Baby G to negotiate with the creditor. So they agreed for the following terms. And since we are Baby G, we are as if negotiating with the creditor to settle one half of the loans by transferring our land with a recorded value of 700,000, but with a fair market value of 850,000. And also, at the end of year 1, beginning year 2, we are to settle 1/4 of the loans by transferring 20,000 one par ordinary shares with a fair market value of 15 per share. And the remaining 1/4, we are to negotiate with the creditor to modify the terms so that our interest rate of 12% will become 10% for the remaining 4 years. So, the requirement for this problem is to provide for the journal entries from January 20X1 to December 31, 20X5. So, we need to round off the present value factors to 4 decimal places. So, that's the whole comprehensive problem. So, in this problem, you have an asset swap, equity swap, and modification of terms. Okay? Now, let's have the solution for this problem after this intro. So, at the beginning of year 1, the entry is not complicated because you just have to make a journal entry. Debit cash for the net amount that you have received as Baby G in this example. Okay? Which is again 1,862,774. And again, that amount came from this 2 million right here minus this 137,226 origination cost. Okay? Now, the credit is loans payable for the same amount. So, that's the only entry at the beginning of year 20X1. Now, the only problem with this is the completion of the timeline because we cannot move on without the proper effective rate. And remember, in this case, we cannot use the nominal rate, this one, because the proceeds is not the same with the 2 million. Okay? So we need to find out the rate that we will need to apply for this one. And again, you are to pay 2 million principal at the end of 5 years, so we need to discount this by using 1 plus I raised to the power of -5. And aside from principal, you are also to pay interest of 2 million times 12% or 240,000 every year for the next 5 years. So, because of that, we will need to use 1 minus 1 plus I raised to the power of -5 divided by I to get the present value for interest payments. Now, These question marks here, representing the present value of the principal and interest, should sum up to this 1,862,774. So, to get the effective rate, you need to undergo trial and error, and we need to try higher rates than 12% because the proceeds is lesser than the agreed principal here. I hope you still remember the past episodes. And after that, you will have to interpolate. And since I already know the effective rate when I was making this problem, I will not do the interpolation anymore because it seems silly. Interpolation is just effective if ever you don't know anything yet about the effective rate. So, the question is, what is the effective rate? You will know that after this. So, the effective rate is actually 14%. Now, let's check if it will really result nearest to this 1,862,774. Okay? So, this 1.14 raised to the power of negative 5 is actually 0.51937 times 2 million, and we will get a present value of 1,038,740. Now, the present value factor for this one here is 3.43308 times 240,000 equals 823,939. So that's the present value for interest payments. Okay? Now, let's add these two present values and we will get 1,862,679. And even if it is not the exact number here, it's very near, right? So we can conclude that the effective rate is actually 14%. Okay? Now, since we have that already, then we can continue the timeline. So 1,862,774 times 1.14 equals 2,123,562 minus 240,000 because according to the problem, Baby G have still paid interest at the end of 20x1 or end of year 1. So again, 2,123,562 minus 240,000 and we will get 1,883,562. Now, as for the entry, we have to debit interest expense, which is just the difference of these two. And that is 260,788. And then of course, we credit cash for the interest payment of 240,000. And since the expense is greater than the interest payment, then the result is the payable will be increased. So we need to credit loans payable of 20,788. So that's the entry. Now, for the debt restructuring twists, let's have that on the next episode to keep this video short. Okay? So if you've learned and you still follow, please click like, subscribe, and hit the notification bell to be updated on my next videos. So see you on the next one.